that connects individuals within our communities to resources, information, and opportunities. And tonight, as we try to understand the stock market, the question I put before you is, do you want to invest in the stock market? Yes. Do you have the basic understanding of what it takes to understand to invest in the stock market? Yes, no, maybe so. You're not alone. And in view of that, we have an expert, the founder and CIO of MCL Capital, which is a hedge fund and a sub-advisor using quantitative and statistical analysis to predict equity behavior. They allocate capital and generate consistent returns for their investors. We have Mr. Adeniyi Ajoloko, who is a mathematician with a bachelor's degree in mathematics and statistics, 2 Microsoft certificates, a master's degree in accounting, CPA license, and an MBA finance candidate at Carnegie Mellon University. Prior to starting MCL Capital, Mr. Ajoloko served as a manager in the Wealth and Investment Management Division at Morgan Stanley and as a financial consultant for large hedge funds and asset management companies while working with Ernst & Young LLP. He's an avid soccer player also, philanthropist, and a motivational speaker. And so, further ado, I would want to introduce you all to Mr. Ajoloko from MCL Capital.
Thank you so much, Darlington. Thank you. That's major. Thanks for having me today, and thank you all for joining. This is wonderful. So wanting to invest in the stock market. Darlington, what's the cadence on this? You want to start with a question? You want me to lead with just brief?
We would prefer you giving us a brief understanding of how the stock market works. But what is the stock market?
Okay. So I'm assuming that a lot of people, most of you online, have a general understanding of what the market is, the stock market. It's a secondary market where people trade shares of their equity in companies. So, but in the general understanding of it, you can buy and sell stocks like Apple, Google, and try to make money. Basically, it's a profit generation platform for all. So, but to address the question here is, how do you make money on the stock market? So basically, you know what the stock market is, but how do you Can we mute that, please? Thank you. So I put together just a few background knowledge that can help. So first, if you want to be successful on the stock market, apart from understanding the basics of what a stock is, owning Apple, Google, Amazon, the next thing that's trending, you need to have a strategy. So if I understand correctly, I've been getting phone calls. There are different people who have their daily lives. You have your full-time jobs, but you still want to be able to participate. You still want to be able to, trade and make some money on the side. As great as this is, it is crucial to take the time to step back and develop a strategy to be able to execute that. Now, when I'm talking about strategy, I'm not just talking about the stock trading strategy. For example, first things first, before you decide on what to buy, before you even decide on stepping into the market, I always advocate looking inwards. What are you very good at? What's your field? For example, Darlington, you're in logistics, correct?
Yes.
Exactly. So Darlington, you are in logistics, you know a good amount of what's going on in the industry. So if I ask you, Darlington, can you tell me, with the present situation of the economy, will the volume of shipment go up or down?
Down.
Down. Why do you say so?
Especially with there are less flights going in and out countries than the bans on flights. So obviously, shipping from one country to another is not happening. It's very difficult. So that is one of the reasons why shipments is low. But with the exception of that, the sea cargo takes 1 to 2 months for things to arrive, which is still moving, but still not a lot because people are scared to ship stuff.
So you see right there, Darlington just demonstrated an expertise in logistics because That's your background. Now, when it comes to the stock market, it's crucial to first look inwards into what you know. If
Sorry to cut you, someone is asking what is the Instagram handle to watch via IG Live?
it's at A Ajuloko.
Okay,
A Ajuloko. It's my first initial, last name Ajuloko.
perfect.
Yeah, so thank you. So right there, Darlington just demonstrated his understanding of the logistics field. So if I want to take that further, take that up a notch, Darlington, still with me?
Yes.
So what companies are the major players in the logistics field?
Um,
Particularly, which of them are publicly traded?
and we'll say DHL,
Thank you.
FedEx,
FedEx,
UPS.
UPS.
I am out. Yes.
So right there and there, let's just focus on FedEx and UPS. Everyone knows FedEx and UPS. Now, we're talking about trading the stock market, and I'm saying you need a strategy to be able to have a consistent profit generation strategy. I'm suggesting looking inwards. Now, with Darlington, we've identified that he's an expert in logistics. Now, we've identified two major publicly traded companies that are in FedEx and UPS. So piggybacking on what I asked you earlier, you said the shipment would most likely drop because there's not a lot of flights. So let's assume a direct correlation. What would happen to the stock of FedEx or UPS going forward, at least in the short term?
In regards to the current situation,
Yes,
it's going to drop.
exactly. So that right there, you just pick the short position. So you could, if you're very convinced that based on your expertise, your background, your knowledge of a particular company that's publicly traded on the stock market, and your understanding of current circumstances or situation around you, you can make a decision to either long or short the stock. By long, I mean you're buying into it, saying it's going to go up. By short, I mean you're taking the opposite position that the stock would actually drop. So if you want to be successful on the market, developing that strategy is crucial. And the first step to developing that strategy is looking inwards, visiting your own expertise. All of us have a field that we're really good at. A lot of people, when they call, they say, oh, what's the latest hot stock? What's moving on the market? What should I buy? And my answer to that is, by the time the word is out there that everybody should buy this, it's usually too late. And I'll give you an example. Bitcoin. Everybody remember Bitcoin? Remember when Bitcoin started? I mean, I remember when Jim Cramer was talking about Bitcoin trading at around maybe $300, $350. And Bitcoin rose as high as 17,000 at its peak. So there was a day I was getting a haircut and my barber started asking me about Bitcoin. I'm like, sure. If we get to this point, I mean, it got so saturated that you just know at this point in time, there's only one more direction to go, and that is reversing. And voila, from 17,000, Bitcoin dropped to 3,000. Now, the problem with that was not everybody actually understood the background of blockchain technology. People were just buying based on hearsay, what they say. Those who understood the technology behind it have profited on it up until that point. And the professionals were actually exiting when the masses were flowing into it. So if you were an expert in blockchain at that point in time, you would know that that was not a good time because there were more regulations coming down the pipeline from the SEC. The CBOE was about to start issuing futures on Bitcoin trading, and all the indicators out there were just pointing to a downfall. Again, because you're in that industry, because you understand the fundamentals behind the company, it will be easy for you to make calls, either to long, buy, or short, get out, or take the opposite position, given your background. So very, very crucial in the stock market. You want to make money consistently, you need to have a strategy. So that's number one. And again, that strategy starts from looking at your expertise. So another thing I want to point out there is about your schedule, your personal schedule.
Before we continue, if anyone has questions they would want to ask, they can ask their questions in the chat room, and I would ask the questions for you on your behalf. There we go.
Okay. Thanks, Valentin. So yeah, that's one aspect about research. The next thing I want to talk about is your personal schedule. So I would assume most people in the room are not professional traders. Probably have a Robinhood account, buying this and selling that. It's crucial to know that there are limitations on these platforms. For example, you cannot short sell. Like, if you know FedEx is going to go down, you might not be able to take a short position if you only traded on Robinhood. But there are other platforms, there's the E-Trade, there's Interactive Brokers, and so many of them that would allow you to be able to trade on your conviction. That we can definitely look into going forward. But I want to draw up on looking at your schedule before you even decide on, how you want to go about in the market. So there's a lot of volatility on the market, and sometimes the ability or the timing, your entry and exit is very crucial. So I'll give you, let's say a stock is reporting earnings. A lot of times when, say, the FedEx, for example, next quarter comes out and reports that, oh, things are not going as well. Darlington said logistics will not be moving, and Darlington was right. Logistics is not moving. We lost X amount of dollars, and the stock price started tanking. If you were in a board meeting at your current job at that point in time when the stock was tanking, it might be hard if you had to get out, or even if you said a stop loss could blow past your stop loss, it might be hard to get out. So I always recommend when you're setting up your trading strategy, you should be mindful of your personal schedule as well. So do you want to day trade? Do you want to swing trade? What's the entry time and exit times? You have to factor these things into your trading strategy before you even click the buy or sell button. Very, very crucial. The next thing, on trading about on the stock market is capital allocation and risk management. So, again, I hear this a lot. What should I buy? What should I sell? But not a lot of people ask me, what percentage of my portfolio should I allocate to what? So, Darlington, you gave me an example of FedEx and UPS and one other company, DHL. And I'm not sure if DHL is publicly traded, but let's assume 3 of them are publicly traded. Now, if you look at it on the high level, it almost makes sense that maybe you divide everything in your portfolio into 3 and just dump it on the 3. But guess what? All 3 of them have strong positive correlation. If you put your money in 3 stocks that are doing the same thing as putting 100% of your money in one of them, maybe plus or minus, some variations here and there. So that's why when the market tanks, you just see the S&P take a nosedive, the Dow take a nosedive, because there's still a really strong level of correlation among these stocks. So what I want to point out in terms of capital allocation is that when you are allocating your money into what to buy, pay attention to how they interact with each other. Maybe if everything was settled, you can look at logistics as one direction, then maybe look at another industry, I don't know, maybe computers, technology, whatever it is. And there are other factors that you might want to consider that I will not be able to get into because of sake of time and technicalities. But, like beta, correlation and all that, just be mindful of how much goes into what. Do your research. Don't just dump your money into one thing or multiple things that are headed in one direction.
So, Nee, basically, in terms of what you just said, in terms of the portfolio and investing in different, either in logistics and technology or whatever, basically, this is where you're talking about diversity, right? Diversifying.
So this is strategic diversification. So gone are the days when you can just buy stocks, even in different industries. That's not enough. Because what happens is, coronavirus hit, what happened to the market? Logistics, technology, shipments, which is still logistics. Every industry you can think about, fashion, gaming was doing well. A lot of industries, probably 11 out of the 12 sectors, just tanked because they still mirror the direction of the market. So when I'm talking about diversification, it's not enough.
Okay, please go ahead.
About diversification, it's not enough to just buy different stocks, even in different industries. It's also crucial to consider the direction of the movement of these stocks. For example, some stocks are considered defensive. when the economy is going in one direction, they're probably going the other direction. And there's also the volatility index, the fear gauge, that does exactly the opposite of what the stock market does. So when you're building your portfolio, it's always crucial not to have everything headed in one direction. Because yes, a rising tide will float all boats. But on the other end, when things crash, you don't want your entire portfolio. I mean, that's where, the concept of bonds come in. Fixed income level. The traditional allocation method is usually 60% stocks, 40% bonds. If you had a good amount of your portfolio, say 40% in bonds when the market tanked, at least that part of your portfolio will not tank with the rest of it. You would have some measure of protection in your portfolio as opposed to just having everything go down the drain.
So now you mentioned stocks and bonds. What are the difference between stocks and bonds?
So stocks, the equity. So basically, we have a share. So you and I, Darlington, comes together. You give me $50, right? Total $100. 50-50 right there. You have 50% stake in whatever it is we're setting up. I have 50% stake in it. That's just a simple, pure and plain example of stocks. Everyone has a stake based on how much they contribute. Now, with bonds, if I give you money or you give me money to go do whatever it is I do, and we have a contractual agreement that I should pay you back at X percent, say 6%, for example, municipal bonds at the end of the year, you just basically bought a bond in my company. So it's a debt instrument as opposed to equity. So the stock is the equity where we have shared participation. With bonds, you have less exposure because all the risk is on me. Whatever happens, I still have to pay. That's why in the event of the bankruptcy like Hertz, the bondholders will get paid first when the equity goes to zero. So
Okay.
we can definitely dive more into it, but that's just it on the high level. So one is a debt instrument whereby the company is legally obligated to pay you no matter what happens. The other one, you both share the gains and losses. So everything goes well, you share it. It tanks, you share it.
Okay. So someone asked the question, and the person said, "Can you please briefly explain short selling? What exactly is it?"
So short selling, on the high level, it's the opposite of your regular buying stock. So what we're all used to, what we understand traditionally, just like Robin Hood gives you, is you can buy a stock, say Amazon, Apple, you believe it's going to do well, and what happens? It just, things go in your direction, you're making money, it's doing well. So we call it the long side of things. You're long in that stock. Basically, you're buying into it, believing it's going to go up. However, if, like you said, Darlington, you have an inkling or an understanding that a particular stock might go down, there are ways to still profit on something that's going down. And that is where short selling comes in. So I will try to use an analogy to explain. So you come to me, Darlington, I have a stock of Apple, and it's right now trading at $100. You say, "Hey, Ade, borrow me your Apple stock, and I will give it back to you at a later time." So you come to me, you borrow the Apple stock. It's trading at $100. I can charge you, say, 1%, 0.5% for borrowing it. Like you have the rights to my stock at that point in time. So you're going to pay me for that, some premium. Now you go on the market, you know that Apple is going to go down. Then you go on the market on that very day and you sell that Apple stock at $100. You owe me a stock. Don't forget that. But now you've sold it on the open market. So you hold on to that $100 and you're waiting for your prediction that the stock's going to go down. So when the stock goes down to, let's say, $70, you're like, "Yep, I was right." Now you go back to the market
And buy it?
and buy it at $70.
Wow.
So what you now do is you come back to me, "Hey, Ade, I don't owe you $100. I owe you one Apple stock." So you come back to me, give me back my Apple stock, and whatever premium we agreed on, you just made $30 on that transaction. So you literally short sold my stock. Does that explain it? So that's exactly what short selling is. You're borrowing to sell now to buy back later so you can make a profit. Now, on the flip side of it, if things were to go wrong, you're not your way, and let's say Apple from 100 goes to 150, you still have to give me back my one stock, but now you can't buy it for 100 anymore. You have to pay more. So that's why it can go either way. You got to be careful when you're short selling. But if you're convinced it's a risk you're willing to take, it's a very profitable venture. And there are billionaires who have made a lot of money short selling stocks. Like Jim Chanos is one of them. George Soros, shorting the British pound, because it's not only stocks you can short. You can also short currencies. There's a lot of other instruments. As long as you want to take the opposite side of the bargain, the floor's open for you. But again, I need to put this out there. The regular trading platforms like Robinhood might not let you short sell stocks because of the intricacies involved. They're trying to, for the most part, protect you. You want to make sure you know what you're doing. If you know how to short sell, you can now go into the IBKRs, the E-Trades, and so on and so forth. So yeah, did that answer your question?
Yes, you did answer the question.
Yes.
Also, the same person asked, what platform would you recommend us to trade on? Because you've been mentioning Robinhood, you've been mentioning E-Trade, and you mentioned that Robinhood usually doesn't allow short selling. So what are some of the platforms you recommend? Is there a way to look at the fees of each platform?
Thank you. So that brings me to the next phase of what I was talking about. Remember, I was talking about strategy, looking inwards, finding where you're good, and knowing what position you want to take. The next phase is execution. Now, every strategy is good until you have to execute. But execution is really the key to making money on the stock market. It could be all in your head, but actually using it to be able to generate returns is crucial. So that brings us to the choice of platform, like the person asking the question. What do you want to do? What platform allows it? And what are the fees associated with it? Some research will be involved in this. And it's not just, sometimes you still also have to think about the choice of the instruments. So there's stocks, right? In Apple, for example. Apple also have bonds. And there's options and probably futures, derivatives that are all linked to the same company. So depending on the strategy you want to execute, depending on the direction you want to take, you have to do your research in terms of the platforms that will be able to help you achieve your best goal. So that's why, execution, when it comes to execution after identifying your strategy, is very, very crucial. Another point I want to mention is the use of margin. So basically, margin is like an amplifier. If you plug good music into an amplifier, what happens? The whole neighborhood is dancing, everyone's happy. However, if you put an eerie sound into an amplifier, it's going to piss everyone off as well. So it's the same analogy I would apply to stocks when it comes to using margin. So you can use margin to improve or boost your returns. For example, when you're trading futures, even with equities, which is stocks, you could have, if you're a PDT, a pattern day trader, sometimes your brokerage will give you a buying power of 4-1. If you have more money, they can give you 6-1, depending on the platform. And that helps you be able to buy more and make more. However, on the flip side, margin could also be detrimental if you don't know how to properly use it. So a good example, I'm not sure if Robinhood allows you to trade on margin because I think you're limited to like 3 years. And please, I keep mentioning Robinhood because the calls I've been getting are Robinhood. So it's a great platform, but just being aware of how, things are running.
In terms of Robinhood, I feel like it's a platform that has given a lot of people the opportunity to get into the stock market, because in the past, it was difficult for especially young folks that have shown interest to have an understanding of how it works and identify the platform for which they can enter into the stock market. In the past, people would think, oh, you need to have a certain amount of money, or you need to know someone who's into that industry to be able to look into it. So what Robinhood has done now is that it's giving people the platform to have them trade on their phone with ease. So yes, it might be a little bit complicated, or it doesn't give you all the opportunities to invest in it. My perspective is that it gives you a little bit, like it gives you a basic understanding of it. And as you start, you will be interested in it and start to ask questions and start to engage with people that are trading in the stock market.
Double thumbs up, Darlington. That's
I'll take
perfect.
it.
Yeah. So because yeah, it does. Before, stock trading was like a mystery. It's something guys in suits and jackets, on Wall Street do. But now, even your 6-year-old could trade stock if you can open a Robinhood platform for them, which is very good because now everyone knows what's going on. People are following the market because whether you follow or not, it's tied to your retirement one way or the other. I mean, most of our 401ks and IRAs are, invested in mutual funds on the stock market. So being cognizant of what's going on the market is very good. And I feel like the prevalence of these platforms has really brought those to light. So that's a very good plus. So continuing on the track of execution, after choosing the platform, depending on what you want to do, considering the use of margin, which Robinhood, maybe I think they might give you up to 2x buying power. Just be careful though, because again, just like you can amplify your gains, you can also amplify your losses. Now, the next point I wanted to touch on in terms of execution is discipline. Now, if I had my way, I would write that all over this screen right now. Only disciplined traders make money on the market. Only disciplined traders. And I'll tell you why it's crucial to pay close attention to this. Now, when I'm saying discipline, it means sticking to your strategy. You cannot afford to go back and forth in your decision making. If you are to a good level of confidence, you have a good level of confidence that over the next course of 3, 6 months, whatever time horizon you pick, that this stock is going to go up or go down, you might still experience a J curve on your journey. And by J curve, just like the letter J, you might take a dip first before you rise. Now, what happens a lot of times is when people see the downward trend, they bolt for the door. Nah, Darlington was wrong. This is not true, or something like that. And then when they get out, they see the J forming. Now the stock is going up. What happens? They jump back in. But then they get to the top of the J when things get flat. Maybe they get in at the time when it gave flat. So you took the losses on your way down. You missed the rally going up. Now you're stuck in limbo at this point. And who knows what the next direction is? It might just, take another leg down. But if you exercise patience and you've done your research, you stick to your strategy, chances are that you might be right. And to be a successful trader, you don't need to be right 100% of the time. That's a myth. It doesn't happen. 51% is all you need to be successful. So if you make 100 decisions on the market and you're right 51 times out of 49, as a matter of fact, 50.002 times, that little margin, as long as you're more right than wrong, you replicate it over and over, you're making money. So it's okay to make some wrong decisions. It's okay when things don't go your way, but it's crucial that you stick to your strategy, because if you exit too quickly or you just, try something else, you just find yourself trying, and your capital is depleting. Then you say the stock market is rigged you out. You want to say something, Darlington?
So, Lee, you're talking about when to enter, the strategy, when to enter and when to get out. Especially during this time, during this coronavirus season, COVID season, a lot of stocks that have gone down, and there have been some that have gone up. Like Zoom, for instance, Zoom went up. It went up.
Mm-hmm.
But then,
400%, I think.
with a lot of stocks going down, people are now saying, "Oh, the stock market is going down. This is the best time to get in," and everyone is like all about stock. Oh, I want to get into the stock market. They're all interested in the stock market. What advice would you give folks in this era, in this season, in terms of entering into the stock market? Because one thing I noticed, I lost some money recently. I bought a couple of stocks, and um, then it went down. They did a 20 to 1 sale where if you had like 20 stocks, it becomes like one.
So they did like a reverse split.
A reverse play. There we go. So like with this season, what are some of the advice you give to folks in terms of investing during this season when the
It
market
is
is doing bad?
dangerous. This is what I'm going to say. It is dangerous to invest on hearsay. 90% of people lose money on hearsay. Yes, I think between March and April, the stock market experienced a major dip. And some people have been very fortunate to come in after that time. But we need to parse out the information here. When we say the stock market, people confuse, or better put this way, when you hear the term stock market, your mind should go to the S&P 500, the major averages, S&P 500, the Dow, the Nasdaq. That's the visible measure of how the overall market is performing. However, there are still components of the market, of these averages, that do not necessarily do what the major averages do. And a good example is Zoom, with the platform we're on right now. I mean, normally this event will be held live, but due to the current circumstances, we're having this in Zoom. And for that reason, Zoom has really gone up. So getting into the stock market when people saw the crash is a good idea if you identify the unique opportunities that will benefit you. So, for example, if you came in with a strategy of buying the dip, so basically you're looking at stocks that have underperformed, like your Boeings, your United Airlines. I mean, pick a name. They probably crashed when Corona happened. So if your strategy was to come in and buy these guys when they were low, you cannot just blanket buy either. You still have to do your research. For example, some people will have the thesis and say, well, the government is going to bail out Boeing. Government is going to bail out the airlines. Home Depot is not going to crash. People are still going to.
Oh,
Hello?
me? Yes, I
Yeah?
can hear you now. Yeah.
Okay. So basically, it's not enough to just want to buy the stock market. You still have to have a strategy, some kind of conviction based on your background, understanding of current circumstances to be able to pick the names you want to get into. Now, if you wanted to get in on a macro level, on an index level, the stock market, then you can buy, say, ETFs based on the S&P 500, the Dow, and the Nasdaq. That's you investing in the stock market. But if you wanted to go in on the stock by stock level, you can't just blanket buy. You have, for example, Hertz. Hertz went bankrupt. JCPenney went bankrupt. So you might think, oh, they went down, they're going to come back up. You rush into them, you buy. Guess what? You buy to zero. Because whatever price you bought is going to zero. And like I mentioned earlier, if you're not a bond investor, when a company files bankruptcy, the share price goes to zero, you lose literally all your money. And whatever commission you had to pay, you still pay. So that's a double whammy right there. So it's careful. It's crucial to know how you're coming in. Are you coming in on a macro level, the stock market? Then I strongly suggest going with an ETF based on an index. There's the SPY, there's the SIA, the DIA. These are ETFs that mirror the indexes, the stock market. But if you're coming in on a stock level, you have to do some extra research so you don't buy something that's going into bankruptcy.
So, you mentioned ETFs. Someone I'd asked a question earlier on you expanding on ETFs, and the same person basically asked a question around SSP. What is the difference between the S&P index and the ETFs?
So the S&P index, let me just differentiate both. The S&P is a basket of 500 stocks, averaging whatever math is going on there to give you like a measure of the index. So you have all these companies and their stock price You lump it together, get the average, you get the value of the index. So it's a pulse. It's a metric to give you the pulse of what these 500 stocks are doing at that point in time. Now, you cannot buy the S&P 500 itself. Now, there are ETFs, which are exchange traded funds that put together a portfolio to mirror what the S&P is doing. So some of them will probably buy the top 200 S&P stocks, or the S&P stocks that have the highest beta, which is a correlation to the general pool. ETFs like SPY, the levered version, SPXL, DIA, and so on and so forth. There's a lot of them. What they do is try to mirror what that index does. So the S&P 500 is the index, the general measurement. Now the SPY, the ETF, is what mirrors what that does. Does that make sense to answer your question?
I mean, yes, you did.
Okay,
Let me ask. I'm sure the person will ask a question if they did get an understanding. Someone also, yes, the person said thanks. Yeah, thanks. And
good.
what is the importance of data gathering in understanding and engaging in the market? And where are these data gathered from?
Thank you. Well, I can overemphasize the importance of data. I'm a mathematician, so what we do, everything is based on data. So we are very, very big on gathering data. So every decision we make at MCL Capital is based on solid data, historical data, and it's all over the internet. Talking about where you want to get data, there's everywhere. Yahoo Finance, and it's free too. Just an FYI, Yahoo Finance is free, Google Finance is free, Market Trader, Market Beat. I can go on down the list, Zax.com. Even if you go online in Google right now, you type in Morningstar. Thank you, Tammy. There's a ton of them, and they actually have ratings and opinions of analysts depending on what you want to do. So yes, there's data everywhere, and I cannot overemphasize the importance of data gathering. Now, there's quantitative and qualitative data. Just to pass that out. So quantitative is when you go on Yahoo Finance and you download the numbers, the historical trading prices. Now, qualitative will come in when you do your research. For example, you, Darlington, in the logistics industry, just having an idea of what's going on. You might not necessarily be able to tell me that the volume of shipments will go down 80% or 70%, but you qualitatively know that it's going to go down. So sometimes you can still transfer that qualitative data into quantitative data by assigning numbers to them. 1 for up, 0 for down, blah, 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 and things like that. And you build a table, run some models, and you're trading on quants. So data is very, 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 very crucial to decision making, qualitatively or quantitatively.
So, in regards to the stock market, what is one looking for in terms of the data when you look at the data, whether you go on Yahoo Finance, Google, what are you looking for to be able to apply in your investment strategy?
So when you start with your thesis, you want to get an idea. For example, say I'll keep going back to your logistics example, if that's okay. Just
No problem.
Yeah. So let's say you have the thesis that FedEx is going to go down, UPS is going to go down, but you're not 100% sure, and you want to have some data to back it up. Well, what can you do? You can go on the stock market and look at how these stocks perform in the last pandemic or something similar to the pandemic. Now that's what you're looking for in the data to prove or disprove your thesis. So there, you can't just gather every form of data out there. You pull the data to either prove or disprove the thesis you have on your strategy. So if you want to be convinced, or you want to be sure before you put your money into it, if FedEx is going to go down, you might look at, I don't know, what happened during the Spanish influenza. And maybe for some reason, even though you thought that FedEx was going to go down, the shipment for PPE, the gas masks and the other equipment, goes up. And the volume for that counteracts the regular day-to-day volume, and the prices, maybe the government is giving a premium. Say, hey, FedEx, we know you're not going to be doing your regular stuff, but we're going to give you $3 billion to be able to make these things available to everybody in 1 day, 24 hours, whatever it is. Now, even though you had a thesis, being armed with data, qualitatively and quantitatively, will help you decide whether to pull the trigger or not. Because now you know that even though you thought like this, the numbers do not support the stocks going down. There's going to be money flowing there. And a good example, look at the stock market. I had an article on LinkedIn showing how disconnected the stock market right now is to our everyday lives. Like when the market was running right back up after the initial crash, and you were hearing numbers of coronavirus go up, yet the market was going up. You would think the reverse would be the case. The spike in cases, down goes the market. But guess what? A new factor stepped in, the Federal Reserve. The Fed started pumping money into the market. And when there's liquidity, it will alter the flow of demand and supply. If there's someone willing to buy anything anyone is willing to dump, then the market and the prices will not go down as it's supposed to go. So again, after having the thesis in your mind that this will happen, then you go back and you do your research, current data, historical data, that will help you know at that point in time that, well, even if I think this is going to be the case, based on these other factors, I might be wrong. For that reason, I won't do this or I will do this. Make sense?
It makes a lot of sense. Someone also asked the question, what are your thoughts on robo-advisors?
Well, think about it this way. Who builds robos?
Individuals?
Exactly. So a robo is only as good as a builder. I have nothing against, we use algorithm trading. We have developers in-house who code algorithms, but they develop algorithms that execute our research. See that? So before the stock market, robo-advisors were doing well because most of them were just buying large caps, mid cap, small cap, average it out over time. You mirror what the S&P is doing. There's nothing wrong with that. But a lot of them, most times don't, probably do short positions. And these robos, I don't know how often these algorithms are, say, recoded to mirror current trends. So on a generic and overall platform, I would call them just another tool to execute the thoughts of the programmers. If things are going the way the programmers thought, the robots will be doing exactly that and making money. If things go south and the robo is not recorded, it's going to be losing money. So my thought on robo, it's just a tool. It only mirrors the underlying thesis of the developer or the people in charge of the robos. Okay?
Perfect. That's perfect. Bookie had asked a question. She said, what has the highest risk, short or long-term investment?
I'm going to take a borrow leaf from Warren Buffett there. The Oracle of Omaha, doff my hat to him. He's always a huge advocate of long-term
investments.
Yeah, because the reason is that, like you said, in the light of risk, looking at it from a risk management standpoint, long-term investments have lower risks. And the reason is this. Over time, the market will go up. No matter what happens, even if you have 20 coronaviruses back to back, at some point, we're naturally optimistic in nature. We want this to improve. We're building all this technology, we're building factories, we're doing things because human evolution is getting to a higher level of consciousness as time proceeds. So the stock market mirrors that as well. So in the long run, now I don't know if this is going to be a lifetime or maybe how long is long will be the next question. Is it 2 years, 3 years, 5 years, 7 years, depending on your tolerance and your risk threshold. Long-term investment would always dwarf short-term investing. However, that does not say that short-term investing is back. That does not say that it's necessarily, I mean, I wouldn't say riskier. The risk tolerance would depend on the investor, because there are day traders who make a lot of money just short-term trading. Once you have a defined strategy for your short-term trading, you could be making money on it. But overall, yes, I would say you're safer in the long run than in the short run, relatively.
So one stuff that I will bring to light is Square.
That's
I
good.
remember around 2016, Square was like $14, and Square is currently like what, in the 80s or so.
Yeah.
Um, so would you encourage someone to invest long term in Square? I remember like 2017, what's the name? Um, this company, I'm trying to remember the name, invested in Square, and the Swiss bank had
Okay.
invested money in Square, and which helped boost it. And the argument was that Square was only at that time was only in North America and hasn't branched to the rest of the world. So
Yep.
would you encourage someone to invest in that particular stock from your point of view?
Now, I will not, nor will I, endorse or disendorse, permit my use of English, the investment in Square Cash. But I'm going to give you a general analysis
Because
on why.
currently Square is at 104.
Yeah, 104.3.
Yeah.
And it's done very well. And Jack Dorsey, the CEO of Twitter, is the same CEO for Square, and he's a phenomenal guy. I respect him a lot.
Yes.
Able to run two major companies like that. That is it's something worthy of accolades. Now, Square Cash, yeah, if you looked at it back then where it was, again, whoever it is, Swiss Bank that came in, believed that there's room for expansion. So they put their money in Square, and it's paid off greatly. Now, some would argue maybe it's too high where it is. Maybe you're late to enter. But think about an Amazon. Amazon's trading at what now? Over $2,000?
Mm-hmm.
Would you say it was too high at 100, 200,
Like
300, 500?
some people thought that.
Exactly. So that's the thing. You need to build your thesis. You need to have your level of conviction so you can sleep well at night whether you made money or lose money. If you think that maybe Square can still go to Africa, if you think that, I mean, think about it right now. Square can now do the CARES Act loan for small businesses, right?
Mm-hmm.
That's a boost on the platform because there's more traffic, it's more money flowing through it, and there's only the probability that they get more business only goes higher from there. And Square is gathering immense amount of data on small businesses. Like they have the level of exposure that the JP Morgans and the Bank of Americas do not have. The food truck guy uses Square. You and I use Square, Square Cash to send money to each other. So again, I would not recommend or not recommend Square, but looking at the current circumstances, the business environment that Square operates in, there could be room for upside, but hey, the question is when, right? So, the question is when. Is it going to go down before it goes up, or is it going to go up like tomorrow morning because Darlington said so? We don't know. But yeah, again, do your research, and the thing with investing is you have to be comfortable making a decision and sticking with it. If you're convinced that this is going to go up, you buy it and you wait it out. You might have to wait long. You might not have to wait much long. And that brings me to the third part of what I was talking about, which is having a target. And that's one thing most traders don't do.
Mm-hmm.
You just buy a stock. Oh, it's going to go up. The question is, what are you looking for? Do you want the stock to triple in size, double, quadruple, or you want to make a 10%, 5% return? It's crucial to have a target.
I actually like the fact that you're mentioning that. I remember 2 years ago, I bought stocks in Aurora Cannabis,
Yeah.
and at that time, legalization of cannabis and everything, I put a lot of money in, and the stock market was doing well, and I was putting more money. It was doing that, and that stock was doing well.
Yeah.
And then it gets to a certain point, and then it starts to drop. It drops, and I'm like, oh, it's going to go up without having the target. My mind is always going to go up. I'll make money, and then it was dropping. I'm like, oh, it's okay. I'm going to make money. It's going to go up again because legalization, everything, and all of a sudden I realized I was losing a lot of money. So I really appreciate you mentioning that you should have a certain target and
Yeah.
where you want to
Yeah.
go.
Talking about cannabis stock, I had a friend who invested in Tilray, which is
So,
one of the
yeah, totally.
a lot of money. He made a ton of money on paper. So that's the problem. When you don't have an exit strategy, again, coming back to having a strategy, when you have your thesis, you define your target. If I get a 10% upside on this stock, I'm okay. Or I will shave my position. Whatever it is, you have to have that at the back of your mind because, yes, you might be lucky. I take Zoom, for example. We're all on Zoom right now. The stock is on a tear. Their last annual report was, knockout. Wall Street was celebrating it. Oh, wait, what happens when coronavirus goes? What happens when people start going back to their normal lives? Would it still keep going up? Maybe, maybe not. Newton's law, for every action, there's an
It's
equal
all
number of
opposite.
reactions, right? Exactly. So you could have a bull thesis for a stock and a bear thesis for it. But then the major factor is, what time horizon does your bull? Because everyone, even the clock behind you that's not moving right now, I don't know if it's moving, the second handle will be right twice a day.
Mm-hmm.
Yeah, that's correct for now. Even a dead clock will be right
Yes,
twice a
that's
day.
great.
Exactly. So whatever it is, you decide, you have to, factor a target into it. So if you hit your target, you're good. Get out. Like the Aurora, the Tilray.
Mm-hmm.
And what some people do is when they hit their target, then they set like a stop loss. Okay, you don't want to miss out on the rally if it continues, but you want to make sure you don't lose all the money you just made. So that way you say, okay, you know what? Aurora has hit my target. I have a plus or minus 5%, threshold. Sorry, 1 second. I noticed the Instagram thing went off, and I am just sorry. I'm just gonna put this right back on. The video will be available soon. Um, how do I go live here? I'm sorry, guys. Just 1 second, making sure that those on Instagram live are not completely cut off. Um, okay, well, anyway, okay. Well, I'm just gonna leave that for now.
So Nee, we're actually close to time. So we
Instagram.
can jump into a few minutes to answer some of the questions people have.
Okay,
Someone asked, what is your take on penny stocks?
very risky.
Very risky.
And with more risk, more reward. You can make a lot of money doing penny stocks. You can lose a lot of money doing it. The key word to trading penny stocks is strategy and capital allocation. You could be allocating 1% of your portfolio to a penny stock, but allocating 50%, 33%, too much of your portfolio to a penny stock that could go either way is too risky. You can trade anything, no matter what the level of risk. The key differentiating factor will be allocation, portfolio allocation. How much are you putting into it? If everything goes to zero, what percentage of your portfolio goes to zero?
Okay,
So,
and someone was also asking, does the stock price reflect financial health? And some companies cost more than Apple, but don't have anything close to the market cap.
the stock market as much as possible tries to reflect what's going on in the company, but there are still some forces, call them the hand behind the scene, that can move stock in either direction. For example, if Warren Buffett comes out today, which a very well respected person, and says, I am buying Darlington stock. Not everybody cares why Warren Buffett is buying it, but because it is Warren buying it, people pump into it. Does that mean it's a good company? Maybe, maybe not. And what happens? The stock price will go up at that point in time. Now, if a Jim Chanos, the short seller, comes at the same company and says, you know what, I'm shorting this stock, people are going to bolt out through the door because of Jim's, history of, being a good short seller. They think he sees something. Is he right? Maybe, maybe not. But influential, people like that can have factors. They can have major influence on the stock. So it's crucial that, yes, it tries to reflect what's going on in the company, but sometimes there are other factors that makes it, walk out of the normal distribution.
So Regina asks, when does the company whose stock is being traded make money off of the sales?
At IPO. So at IPO, that's when this company that actually gets the money. That's when they offer up their shares for money. That's when they actually do make the money. Now, what we are trading is a secondary market. What it does is it boosts their market cap. I mean, does it really give them the money directly? In ways. If they had to take a loan from the bank, they had to get a grant, they had to do this, their market cap is like major collateral. Think about it too. The executives of the company holding the stock, if like Jeff Bezos, who owns what? Is it 16% of Amazon and is worth over 100, I think almost $150 billion right now. Think about what other executives are worth too. And this network keeps growing because of the trading going on in the secondary market. So yes, the company does benefit from it because there are original shareholders that still have, their stock in that company, apart from, what the general public does have. So yeah.
Rashida asks, is it possible to actually outperform the market yearly?
Absolutely, 100%. There are tons of investors and traders that beat the S&P out of the water all the time. It's just they will not come on air to share the strategy with you, and most of them just operate and fly under the radar. And there are still some, on average, keyword on average, that are outperform the market. So I'm saying, let's say the S&P is giving you 8 to 10% a year, and these guys maybe made 15% this year, 12% next year, 30% one year. You take the average, it's more than 10%. On average, you just outperform the market over the number of years. So yes, it's very possible to do it.
So Juliet asks, are there any black-owned public traded companies?
Yeah, actually, as a matter of fact, 4 of them right now are out there on the S&P 500. I think one of them is the what's this fashion brand? There's one fashion brand. There's MRK. I mean, if you go on Google and type in, I'm pretty sure there's 4 of them, and they're out there, and they're doing well. They're doing well, representing.
Beautiful. And before we conclude, Temi asks, after this training, can she join? I know Temi a he or she join your platform at least for some days to see how you trade and possibly mirror same until I'm fully comfortable trading by myself. So what they're saying basically from this question is that how can they connect with you so that they can build more or build an understanding in the stock market?
Yeah, I mean, I do understand that we have an hour. It's pretty much just short to be able to dole out all the information. I mean, whatever time we have on Zoom is short to be able to dole out all the information to become an expert stock trader. But please feel free to reach out to me. You can hit me up on Instagram. You can shoot me an email. It's my first initial last name, ajoloko@mclcapitalmanagement.com. I'm going to put that up there. And my Instagram is at ajoloko. Also, you can reach out to me on LinkedIn. It's Adeni Ajuloko up there. So you can send me a LinkedIn email or just buzz me up. However, and the powerful Dynitiks platform. If you're connected to Darlington, you're very, very close. So just reach out. I'm more than happy. Again, I am a huge advocate of sharing, information. So please reach out. Any question, I'm more than happy to work.
That is beautiful. I believe one of my colleagues, Idawu, would do some closing remarks. And first of all, I just want to say thank you so much. And Idawu, if you're on the platform, we will really appreciate it if you can unmute yourself. Give me a second. Let me see if I can unmute you.
Yeah.
Okay, Idaho.